Good day, Craftsman traders. I trust you are well and I trust you are enjoying this broadcast, which I post every now and then. Now, if you are one of my coaching clients, wherever you are in Asia, Singapore, Malaysia, Egypt, South Africa, I'm so grateful to all of you guys, but you will have noticed immediately that I've stripped away the EMAs for the purposes of just this demonstration to the other traders. Now, this is gold. And gold, everyone's talking about gold and how you could have traded gold and made money, etc. But we've got to look at our strategies, right? Sometimes the market just does absolutely nothing for us. We are trading the 15-minute chart and we are looking for any one of our three strategies to set up. Now, this, if we just go here, just all the way up Asian session on the 29th. This was Friday. So if you're in the market on Friday, I work half day on Friday. So I was out of the market at 12 noon, my time here. So I had to look at this and I said, oh, fantastic for the guys who traded this. So if you were trading this and looking for trade with our strategies, you would have clearly noticed these three breakout trend candles coming from the lows that we have here. And you would have waited for strategy number one to set up. There was strategy number one setting up quite nicely for us. You could get in above here when the candle had closed. Let's use that. And of course, I always say to guys, we're taking strategy number two, you got to use a measured move stop. There is a measured move stop. And you look to the left, there is the technical level to place your stop at. So your stop would have been here. And of course, you're taking out trades, the high probability trades, you're hoping to get at least 1-to-1. And with this particular entry, you would have banked a nice, clean 1-to-1. Now, how is that for just perfectly fitting our strategies? Could you have traded any of this, not on gold? If this was, this, as I said, this is right bang at the open of London. If this was an index, any other index, not a US index, for example, yeah, you could have looked at taking that and saying, well, there's a breakout taking place. I can take the trade here and put it here. But for gold, we don't trade as an index. You know the rules, guys. So absolutely fantastic. Our exponential moving averages would have given us additional information. Now, after this, look at this beautiful breakout. You jumped into the trade. You're rewarded with beautiful, beautiful, because they are closing on their high, they're opening near the low, they're strong breakout trend candles. You had another strategy number two setting up here. So if you're already in here and you follow the rules that we talk about, risk management, you would have removed half your risk after entry, like we always do. And at that point, you could have put your entry there and put it at break even. I would have done that because I'm pretty quick with how I do things. And some of the guys who've been working with me now for at least a year are pretty quick in doing that. So if you are doing that, that first trade is there beneath a breakout trend candle. It's a break even, and you see that. Now, this is where you got to think. We never use tight stops, guys. So you'd be jumping into that trade, and your stop, of course, would go in the correct place. In the correct place, okay, I'm going to do this, but because you're following the video, it's easy for you to take note. Your stop would be there. That is where you would place your stop. Let's just clean up this a little bit. So that's where you would place your stop. Now, the second trade is a break even. Had you not taken the first trade, you've got to take that. You don't know how far it's going to go. You don't know all of this, but you got to take a trade. As soon as you take that trade and your stop is here, and of course, you follow the process, now both stops will come to this level, right? So you got half the risk. And then as we start to go ahead, trail your stop up, trail your stop up, and just wait to start to go sideways. I would move my stop to here. Story, and probably you would have been stopped out. Maybe not, but probably would have been stopped out, which is perfectly fine. That trade a bit of a profit. The first one, fantastic profits. And then we went sideways into the rest of the US session into the evening. Now, this was the weekend, and then we opened. We'd have seen the beautiful bull move and said, okay, I wonder if the bulls are strong enough. We had this trading range here. Okay, now this is for my guys trading the in Asia, right? You'd have seen that. I'm fast asleep by then. I used to get up and trade Hang Seng for a long time and I enjoyed it. And this here was when Hang Seng index opened. So that I kind of use that when I'm talking to my traders in Singapore to say use that as your anchor, right? Tokyo opened a little bit earlier, but there is Hang Seng opening here. So that's like the open of the market. And you had, just like you had at the US Open, big bull trend candle, the big bull trend candle there. Had the bears been strong, guys, you know the story would have had a bear breakout trend candle and they would have wanted to get there. But the bears did not even break out beneath that. I mean, that's just a doji. So that gives you confidence to jump into the trade. So you're jumping into that trade. This is a trade at the open of the index. We trade in gold. It's not a country-specific exchange. So this is happening at the open of Hang Seng. So still, the same rules for storage. Number one, there is the measured movement trading range. If you're going to take that trade, there is your stop. So it's in the same zone, and I will just move my stop to here, technical level. Soon as you're in the trade, guys, you know the rules. Take off after risk beneath the candle. We don't just float our stops. Now we're breaking out above the trading range. Guys, here we broke out above the trade range. We had follow through. Here we broke out above the trade range. You've got to wait for follow through before we can jump in and say we're going to take the trade. So big breakout by the bulls at some point and it failed. We're still above the trading range. Then we had that inside candle. You can consider that a strategy number two. The tail is a problem. If you want to take that and say it's set up, but I don't like it, I'm going to wait for the tail or break above the tail, you can do that. Your stop, where is your stop, guys? Your stop is right at, let's go through the steps, George. There is a measured move of that signal. There is a tail. We're waiting for that. Our measured move is here. So your stop, by the time you take in this trade, of course, if you're in the first one, your stop should be beneath that candle in case we come back to it. But if you're taking that trade, there's a stop technical level. So stop must go where stop goes, right? As soon as we into the trade, you remove half the risk, and then you see that and you say, man, what a disappointment. So you can touch in your stop to there. You may not have enough time to move to that. And then when you see that, touch in your stop. And eventually, at some point, if you're quick enough, maybe you might be able to get out break even. When you see that, maybe you can put your stop there and get out break even. But this would have been a beautiful reward, probably the cleanest entry that we've had on gold, but it would require you working late on a Friday. Well, I'm saying late if you're in my time zone, Central Africa time, late on a Friday, early into Asia. It doesn't matter. The strategy is set up as and when they set up across any other currency. All right, guys, name is Dr. George. If you've got questions, if you want to get involved in my coaching program, send me an email. George@georgenyabadza.com. Dr. George Nyabadza. Oh, you'll see it all in the description. Take care, guys. I really enjoyed it. We will broadcast again in the near future. Take care and bye-bye.